Let's do this. So this is Nathan Latka. He is the founder of Founderpath, and there's just a lot of things I like about this guy. I think that I've always wondered how you do what you do. I've done a couple.
Drugs, the good
Yeah,
drugs, the good kind.
I've done a couple podcast interviews with you over the years. I've been on your show a few times, and I think Nathan and I have a shared understanding or belief, maybe it's not an understanding of like what the future of software sales might look like and like how media plays into that. Um, so I want to talk about that a little today. I also want to talk about this shared passion we have for bootstrapping and how that sort of, this is like the life that you're living now, right? You were so profoundly impacted by an incident that occurred to you as a result of institutional funding in an earlier company that it changed the direction of your life. And now all of this media that you do is in service of basically making sure that that does not happen to other people. Did I accurately sort of
Yeah.
describe?
I can't afford you, but if I wanted to hire you for sales, you'd be at the top of my list.
Well, rock and roll, man. We still have people coming in. It's 2:03, so whatever. I think I think it's fair to start now.
Cool.
So let's just start with it. Like, what did you do? What happened, and how did that lead you to be like, this can't be the way, the only way?
Yeah. Well, first off, guys, like I don't want to talk in a vacuum. It's so super cool here to answer Adam's questions, but I also love to just like learn about you guys. So, like, I don't know if you're cool with it. Is it
Oh
okay if
yeah,
people
yeah,
just
dude.
can they
Absolutely.
drop their links in the chat to their SaaS companies really quick, just so I can sort of get a sense of who they are?
100%. And by the way, we can also run a poll of role and then run a poll after section one of ARR range, which we're going to do.
Cool, cool. Okay,
So
so Everflow. Oh, Everflow. Hey, EJ, Everflow's here. Great. Shopwave, Store Connect. Okay, cool. P33R. This is great. Yeah, I mean, Adam, look, I'm always a visual guy, so I'm not going to go through slides, but when you ask me questions, I have the slides memorized and I'll know which one to go through. But you sort of told me that the things that you would ask me about were exactly what you just started with, which is like bootstrapping, valuations, non-dilutive capital. So to answer your question directly, like, guys, this was my embarrassing picture from 2009, my first SaaS company. Adam, I was architecture at Virginia Tech. Can you believe that?
I mean, you look like a very like an aspiring future dreamer, right? Like that guy's going to go out and take over the world.
Yeah, very broke college student, actually, right? But I looked the
Right.
part, right? I had my tie. It was good. This is 2009. Bryce is laughing at me. Do not post this on LinkedIn, okay? No, none of this on LinkedIn. But yeah, this was it, Adam. And I bootstrapped, my mom says, Nathan, but like, how big is your team? And my friends didn't respect me. They say, how big's my team? I said, you know what? I'm going to hire a bunch of people. And this was it. I texted my mom. I said, look, we got 40 people. I hired 40 people in 3 months. Look how big we are. And eventually they said, oh, well, you're not real because you haven't raised VC. So you guys can see here, this was the round we raised. It was 2 million from Techstars on 8.5 pre. And then like, Adam, dude, my cap table just got destroyed. Guys, just type cap table in the chat. Would you like to see my actual cap table after this round? Anybody? And now while they're doing that, Adam, retention, our B2B, purely bootstrapped, right? You and the
Yes,
team
sir.
100%. Amazing.
Yes.
Okay, maybe we'll skip the cap table because not a ton of people want to see it. Just EJ and Ellie. But what I'll tell you is the cap table, like, I just got destroyed. Bryce said, I didn't even know what a cap table was. Yeah, this was, I mean, I don't know if you guys can squint. Can you squint right here? Here's my cap table. And so you can see what I was diluted down to. And this was at 1 million, Adam, of ARR. So bootstrap to 1 million. This is what pissed me off the most, though, right here where my mouse is. Can you see that?
Is that literally what it said?
Yes. Well,
Well,
that's not
in
what it
so many
actually,
words.
that's what it was. Exactly. The Series A
All right.
investors were like, you're in Blacksburg, Virginia. We don't want to fly out there for your board meetings. You need to hire, quote, an adult supervision
Yeah.
COO. I was
Yeah.
like, what the? So to get the person, that was another 9% dilution in terms of
Yeah.
the grant. So guys, like,
Yeah.
I didn't know this at the time, but I mean, I was only 20 years old. I'm diluted on 38%. I mean, it was crazy. Now, if you guys want to check it out, the company is still live because I sold it. It's called heyo.com today, and this company called Votigo owns it. But Adam, to your point, dude, I lost so much flexibility when we did this round.
Can we go into that? Because I think people are like, okay, who cares? 38's still a lot. What does that mean? I lost so much flexibility.
Well, in all fairness, like I didn't know what it meant back then, right? But like today, now that I know the things that catch founders, okay, let me give you my biggest pet peeve that I think a lot of people miss. All of you understand like the importance of not losing control of your board. But I've had founders come to me and brag. They say, Nathan, I'm gonna do a round, but I'm keeping control of my board. And I say, well, show me what the contract says, the Series A round. And Adam, what it'll say is it's a 5-person board, 1 seat to the Series A investors, 1 independent, and then the other 3, like one's the founder and the other 2, they say the common holder, majority of common. It's never worded as Adam Robinson, right? Will have those other 2 seats. So Adam Robinson controls 3. So what the VCs will do is they'll make sure your common gets diluted over time. So you actually lose control of one of those 3 seats you thought you had guaranteed. And then the board is 3 investors to 2 you. You've lost control at that point. So there's all these little things like liquidation preferences, ratchet clauses, drag alongs. Bryce, exactly. Zuck did this because he was smart. Zuck did this to take out his co-founders. So he just issued more common stock, diluted them like crazy. And Bryce, that's exactly what he did. But Adam, I see this all the time. So like that's one example. But the real example was when I got this email from Ryan Alice at iContact, who's now living in Austin. And it was an acquisition to buy the whole company. And if you guys look at my mouse, you can see what the cash price was right here. And this was, Adam, do you see a timestamp on here anywhere?
$6,500,000.
Yeah, 6.5. But I'm trying to remember this was, I think, in like 2011. Right. It was like 6 months after the round. Yeah, EJ, you see it. I can't see it for some reason, but it was around 2011. The board obviously rejected this, right? Because it was 4 million less than the valuation that they just put money in at. And I'm going, what the hell? I still own 38% after taxes as a 21-year-old having 2 million in the bank. Sign me up. Give me the cash. Let's go, baby.
Totally.
You know, put it in T-bills at 5% for the rest of my life. And I'm in Boca, baby. Let's go. Right.
Yeah.
I mean, I'm going to the board meeting thinking this.
Yeah.
And
yeah, you're like literally anticipating high-fiving the board. Like, look at what I did. I got a credible guy with real money to come buy this thing. You know, let's go, right? Like,
I'm ready to go. I'm like, this is amazing. And I go in it, of course. I mean, I don't know if you can see, worst day of my life, I still get goosebumps talking about it. But thankfully, I learned it young. Thankfully, I learned it young. And so that's what I would say. Like, this is a concrete example of losing control.
Love that.
What do you guys, I was gonna say, what do you guys think about that, Bryce, EJ?
Preferred stock can kill founders. Shit, man, I see it. So can we run the roll poll real quick, John? We'll have it up for a minute and then we'll share it with everybody. And as always, your participation is very appreciated because it helps us determine what content we create. Looking about 75% founders, about normal for one of these shows. Okay, so
Bryce is going, I'm the sole founder. I need to check all of these things.
Right.
Clean the toilet, sales, marketing.
Exactly. So Nathan, I know the reason that I knew about you is because as a founder, whenever I would hear about a startup, I would type in, ConvertKit's revenue. Like, I'm like, well, I wonder what that guy's doing, right? And I hear like, startup XYZ revenue, like, Proof. I wonder what those guys' revenue is. And then somehow every single time you ask Google what the revenue of an early stage startup is, Get Latka is the first spot, right? And then that's cool. I'm like, this guy must have figured out how to like arb the machine somehow. But then you actually start listening to your content and it's unbelievable. I mean, to me at least, I'm like, how does this guy get everyone to come on his podcast and start spewing their guts about these metrics? And even if they're not willing to, he like has this strategy of being able to get them into a range and then back out the math. Well, and they're like, blah, 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 blah. It's just amazing. So anyway, like I probably listened to, I don't know, like every company that I have admired, you have interviewed the CEO of. And it's fascinating because you can really get a perspective on kind of like where they're at the time on like just the fundamental key metrics that we all look at. We all, look, we're comparison machines. That's my opinion, right? So like I have forever been trying to figure out what benchmarks are, right? Who these people who are crushing it, what do their companies look like? These people who are struggling, what do they look like? So um I just was in awe of how many interviews that you did and have done and still do. And then, you know, having witnessed the production of this webinar and been a part of it a few times, actually, like I've actually like been on stage presenting, which has been amazing. It literally, I feel like you're Tony Robbins and I'm like Tony Robbins' little understudy, you know, who like comes in for like a few slides here and there or whatever. Um, this is all, there is no one else in anything to do with SaaS that is doing anything like this. Like, so like I basically have two main questions. It's like, where did this start? Where did this come from? Where did this where did this belief that like media done in this way is going to, you know, get you what you want from your business, where everybody else is sending, you know, doing LinkedIn ads and cold email?
Mhm.
Let's just start there. Like where was this seed planted, you know?
Yeah, so a lot to unpack there. What I would say is, I think most people that win in life when you're building a business, the winner is usually whoever does the same thing most consistently for the longest period of time. So what a lot of people do is they see some shiny new tactic, they say, I'm going to do it, and then they quit, right? Because it doesn't match with their personality. They don't get energy from it. They're not in a flow state when they do the thing. I felt like I was in such a privileged position because like I'm a curious person, and when I would interview founders before the podcast just on coffees or whatever, you know, it's hard to get data, but by nature, the board game I chose to play starting in 2017, which is podcasting, is set up and gives me an unfair advantage to win. What I mean by that is the expectation is the interviewer is going to ask tough questions. That's what a podcast interview is. And all I did is I said, I want to have a pattern interrupt podcast. I don't want to do the same thing everyone else has done. So I looked at what podcasts I loved and which ones I didn't, and then created a mix. So I'll tell you, I loved Tim Ferriss's content, but Adam, I'm like a squirrel, right? Like I can't sit for 4 hours, right?
Yeah.
That guy goes for 4 hours. I'm like,
Yeah.
even Rogan now, I can't focus, but I love his content. Great questions.
Mm-hmm.
The flip side of that was like John Lee Dumas, great guy, machine, entrepreneurs on fire, but it's really fluffy questions. It's like sort of what's your biggest failure, like never number driven. So what I wanted was a short and sweet, but hard hitting, right?
Yeah.
So John Lee Dumas length with Tim Ferriss quality plus data. And that's what got us going in 2017. Everything else after that, I've done 3,500 interviews personally, and everything else after that. Yeah.
That is so unbelievable.
Do you guys want to see the back end of how it works? I mean, I don't know what you guys want. You have to tell us yes or no in the comments. But if you want to see like the back end of the machine, like the machine of how it works, I can show it. But like Adam, the thing is I just reacted to what people said. So eventually in 2019, listeners said, Nathan, you've done so many episodes, where do I start? And I said, I need a way for them to search that. Well, that's when we built Get Latka to search. And then I saw the search volume start to increase for the word anyone I'd interviewed, where people would search like RB2B plus the word revenue. And I said, ooh, I should just programmatic SEO every one of that, even for people I haven't interviewed. Because then if we rank number one for that word, I can email them and say, we get all your traffic. You should come on the podcast to make sure it's all up to date and accurate. And it creates a feedback loop. It's like social proof. So that's the quick answer. I can go deeper on any of this wherever you want, but there's a lot.
Does anybody have any question? So by the way, what's the word you use for it? Like the main event is once a month, right? This virtual event where you're on stage and like this, it's just beautiful, right? It's like the production level super high. What does that do for you versus the interviews versus the in-person events that you do? Like, how do you compartmentalize? Yeah, look at this, guys. It's unbelievable. Look at this guy. Like,
yeah. This is all a lot of, it didn't happen overnight, right? But you guys can sort of see this is open hook in the first 15 seconds. You've got to get the audience addicted fast, show a little bit of the background here, show the social proof of everyone's faces in the studio, 196 LED panels, individual faces, and then, show the drone footage so you can see the full studio. And then obviously lots of comments, 3,500 likes, 180,000 views. This then sort of rolls. But I think what you're asking, Adam, is like the framework this is a tactic, but tactics are useless if you don't have a closet with hangers organized to hang the tactics on to make the whole system work. I think what you're asking is like, what's the framework I use when I think about marketing? Is that accurate?
Yeah, and you've mentioned before, you're like, I'm trying to be a zero CAC guy. I think like for this audience of 71% founders, if you were like, hey, by the way, you can, I don't even know if they know that's possible, right? Like I'm obsessed with Russell Brunson because he was negative CAC. I just can't get over that, right? I'm trying to do it myself. I'm doing a one-to-many webinar thing now, like zero CAC, I'm listening. Whatever the next sentence is, if you say zero CAC, I'm listening. So I think that's probably like one of the most interesting parts of all of this, that like, that can sort of play out, through this mechanism that you've created, right?
So let me give you an example. Most marketers say when they want to launch a webinar, they will spend a bunch of money on ads. Like the content's usually not that great. It's usually like promotional the whole time. When I think about a webinar, I go, okay, my studio costs are $3K. How do I make $3K of revenue first to cover that cost? And then I'm not spending anything on ads or anything else unless I make that money. So like one of the things we do on our pages, and you guys can like see me doing this real time. And Adam, we'd love to have you on this one, but like, just so your audience can feel it, if you guys go there, that's our webinar next month. And you don't have to sign up. Just look at how we structure the tickets, right? Just look at how we structure just look at how we structure the tickets. I can't do it because I'll see like the admin view, but if you guys see it, you'll feel it as the end like customer. So like Adam, what do you see there under the free ticket? What do you see?
Yeah, so I see join live training for free, and then I see recording plus slide deck $19, and then I see join in studio in Austin, Texas, required approval $997.
Exactly. So people would say, Nathan, do people actually buy the slide decks? Well, guys, like I'll just show you, right? This is the webinar that just ended today, right? So if I go into manage here, I'm going to show you the sales. This is just selling the slide deck, okay? This was the revenue from that.
That is unbelievable. This I did not know. So by the way, like I got so obsessed with this, I did a call with Nathan, and I had no idea that you were doing this.
Yeah,
dude,
we're always testing.
Like I can't even like. I mean, you are the master at this. Like,
so you got to build a deck that is so valuable, people are willing to pay for it, right? So this covered our studio costs and gave us extra buffer to work with, which we'll spend on the next webinar. We'll spend it on like whatever we want, or we'll just keep it as profits. But this is a real example of like the zero CAC mentality on everything we do. Now, to give you a framework, if you guys want to think about how to do this, I have a specific slide. Let me skip to it. Okay. Bear with me like just for 2 seconds on this, right? So I'm going to go to slide 20. Okay. I want you to think like the 8 wonders of the world. Okay. Just bear with me really quick. This is a monument, right? If Adam, which by the way, Adam, I commented on your post for this webinar. I said, you should write a book with these 7 tips. There is very clear demand. Who thinks Adam should write a book? I think those are the 7 chapters. I think it'll be a bestseller. I think you would crush it. Is it going to happen?
We only have one request.
No,
well, Bryce is like all right. I'd read it.
People would read it, Adam. Trust me. With those 7, if those were your 7 things that you put in that link post, they'd read it. But guys, so look, here's the thing. Now, I wrote this book as I would have been 28 years old. I was the youngest business author ever to hit the top 10 Washington bestseller, and I beat out people like James Clear, right? Patrick Leon, 5 Dysfunctions of a Team, Jim Collins, right? I'm up here like number 3. This is what I'm calling a monument. So when you see this, it makes you feel a certain way, and you can't fake it. In a world where everyone can fake stuff with deep fakes and AI, the idea is how do you build monuments that create hard and soft power for your brand, where when people see it, they instantly want to go, use your thing or use your software. So here are these are monuments. Like everything I do in marketing is how do I build these monuments? How do I get more 5-star reviews on the podcast? How do I get more views on the YouTube? How do I get more founders at the conference so I can get a picture with standing room only like this? How do I get more cable appearances? These are monuments. And the whole idea here is as you build these monuments, this is like the funnel. They build your assets. The assets is your email list, your text message list, your direct mailing list, so getting addresses. And then once you have these assets like the email list, you can then use them to re-promote other monuments. And it creates this open loop. Now, in between there, you'll sell your software services, right? Your software company. So it's sort of like monuments, assets, customers, Mac marketing. Right? And this is how I think about the world, Adam.
I love it. I love it. Okay. Then the next question everybody's going to ask is like, I have none of that. Where should I start?
Okay.
Right.
So the question is exactly that. In 2017, when I didn't have an audience and no brand and no audience, like, why did I do the podcast? It's because I knew I could sit down and do 20 episodes back to back and have energy at the end. You have to do something you could do forever and be happy doing it. So don't go try and write a book if you're a really great podcaster, because you're good at audio, not writing. You know what I mean? Or if you're really good on LinkedIn posts, right? Don't go try and do a podcast, because like what you're good at is writing, storytelling, and visuals on LinkedIn. So like, point is, you want to build a monument that you feel like get energy from doing over and over and over. Like Ryan Holiday, right? With what he did, right? Books, like he knows he loves books and he's a genius and he's top 1.001% of the world at books. Like he's not doing 11 million other things. So the trick is like, establish your thing first, right? So that could be YouTube, it could be podcasting, it could be books, it could be LinkedIn posts, it could be tweets, it could be packed conferences, virtual or in person, it could be magazines. I mean, there's so many things that can be your original monument. We call this monument number one. Once you build monument number one, which for me was the podcast, you use that to sort of elephant bump, and right, and it's your cheat code to get to monument number two, because you take that audience, you then focus it on monument number two, and then boom, start building that monument, and use the assets from monument one to start building monument two. This creates a defensible moat for your software company, because once you have so many monuments, they can't be stolen from you. I can hire Adam's best talent if I offer to pay him, $2 million each salary, right? Someone can steal your code or rip off your base, right? They use a GitHub Copilot. No one can steal your bestseller, which is in every airport, by the way, right? And has 30,000 copies, right? I mean, Adam, it's free marketing, right?
It's incredible. Yeah.
So
yeah.
that's how it works.
This was like one of the reasons I was most excited about having you on. Because like, there's no one who thinks about this in the same way you do. So it's just really good to get this message out. Another thing that I love about this whole strategy that you have is I view it as completely future-proofed, right? If you were to like, on one side, there's like Aaron Ross's predictable revenue book, and that actually worked to get startups off the ground even 5 years ago. Like you could get an email list of prospects, write compelling copy, and 5% of people write you back and dance with you or whatever if you had super low penetration and good offer, right? Like now that number is close to zero, and there are all sorts of technological advances being made to just shoot out millions of more emails, right? So like, if you ask me, things like you're doing are the future. It's like, how is software going to get sold 10 years from now? It's like, it's people who are putting the things in place today, like you are, and building this group of monuments in a way that is in line with the way that the consumption of content is going, right? So like,
well, and in line with the founder market story. See,
yes,
you are perfectly built to build our B2B, because like when you tell your actual story, I've heard you do it. I was sitting there next to Jasper. I was in the office.
Yeah.
I saw how they did it. Then I tried to be like them and it didn't work, right? You can't fake a founder story. So like, if you're just telling your actual story and there's these monuments you build along the way, nobody can ever steal that from you.
Yep. Pay attention to this guy's stuff. So it's like, I would say study Nathan Latka for sure. And then a sort of complementary but different way to try to get to zero CAC is read Expert Secrets by Russell Brunson. There's a lot of, I watch you sell, like you do a lot of what he's talking about in that book, except I think you have your version of it, which is like what everybody has to do, right? I'm trying to develop my version of it right now. So let's move on to the next section. You made this post that I just smiled ear to ear the whole time that I read it. So it's not that long. I'm going to skip the very beginning, but like, I want to read this post to you. And I just know that not everybody understands all of the nuances. There's like 4 different parts to it. So this is about kind of like how a sale of $500 million to Salesforce doesn't actually mean that it's $500 million to the guy who started the company, right? That's what the idea of the post is, right? So let's talk about a $500 million exit to Salesforce, what that actually means. Investors who put in 200 million with 1x liquidation preference got the first 200 million, 300 left. Those investors are participating, which means they own 60% of the company. They participate in the cash waterfall, another 180 million, 120 million left. Salesforce doesn't want the founders to quit, so they make sure that 90% of the 120 million is locked up at Salesforce stock, 96 million, 12 million left. 3 co-founders diluted down to 10% each, plus 10% employee stock option pool, split 4 ways, 3 million each pre-tax, 2 million each post-tax. They've been building this company for 10 years, taking little salary. 2 million over 10 years equals $200,000 per year on a $500 million exit. So there's 4 parts there. Can I ask you about each one of them?
Wherever you want to start. Yep.
Liquidation preference. Tell me what that is.
If you have a $5 million revenue company and you raise $5 million and tomorrow you sell for $10 million and investors have a 1x liquidation preference, it means of the $10 million sale price, assuming it's all cash up front, which is rare, 5 million of that, the 1x goes to pay the VCs back their money first, right? So now you only have 5 million left to split. Now, if it's preferred, they then also get a chunk of the last 5 million that's left as well. So you always want non-preferred or non-participating, right?
Is that an option?
You can negotiate it. Yeah, yeah.
Okay.
I mean, if you're raising from a position of strength, yes, I've seen many people negotiate out of that.
Yeah.
And so the reason this is important is because, like, look, the media's getting bashed plenty right now by our political system, so I don't want to like keep on the bashing. But if I asked you guys how much the founders of Pry made based off this headline, what would you guess in the chat? This is the TechCrunch headline. What would you guess? Let's see what people say, Adam.
Yeah. We're looking for guesses, and it's a $90 million exit. What did the founders make?
Yeah,
50 cents each, says Bryce. 3 million each, 15 million, 3 or 4 million, 60 million, says Andrew Schultz. About 20 million, 4 mil each.
Yep. Okay,
We got
so there's big, wide variety. Let me give you some additional sort of points of information and then see sort of what happens, right? What if I told you that this was prize funding, 4.2 million, right? What if I also told you they got going with their seed round in 2019, right? And they kept sort of doing these seed rounds through 2021, right? Through 4.2 million. Their investors were these people: Liquid2, Y Combinator, Nomo, Hyphen, etc. You see anything here that might change your mind on that price? Maybe, maybe not. What I can tell you is Brex and Pry share the same VCs. VCs need storylines like this in the press to go raise their next fund at a markup. So the investors in Pry would much prefer to have 90 million worth of Brex stock than a $3 million cash exit, because those VCs can then go sell and say, look, we just got a bunch of equity in Brex, right? And mark up their funds to go do their next raise. This was this was, first off, very rarely is it all cash up front. As you know, Adam, usually it's 3 parts: some cash up front, right? Some that's in like an escrow for some amount of time or earn out. And then the last is usually there's stock involved as well, right? So let's assume and I can't share the actual details here, but I can just tell you, do your own research. It was nowhere near 90 million cash up front at all. This was basically an acqui-hire. But if you don't know how the cap tables work and look at the data, you would think these founders just got rich. So it's a total disservice.
So then participating, that was the next thing. What is participating?
Participating means after the VCs get their 1x liquidation preference back. So if a VC put in 10 million, they get their 10 million back first. Participating means then they still participate in the cash waterfall after that, right? So if there's 90 million sales price and a 1x, they get their 10 million back. Now there's 80 million. They'd still get their pro rata percentage of that 80 million as well. That's the worst. Like, the worst term is 3x participating, 3x liquidation preference, participating preferred.
So explain what 3x preference means.
3x would mean these investors that put 4.2 million into Pry at the exit, they get 4.2 million times 3 back
Like
first.
so like this is what's so crazy. Like I don't know much about this world. The fact that that is even a thing that happens to me seems completely criminal. You know, like someone could put $1 in and they're going to get paid $3 back before anybody else gets paid. And by the way, they still have the quote unquote ownership. Yeah, ownership that is after that. It's like I just don't even understand how that, but I guess it's leverage or something, or it's like it's the founders not knowing.
The founders
like,
are weak. Their unit economics are weak. The only way you'd ever give an investor that is if you were desperate for money.
Yeah.
Right. So
Or
like
you didn't
idea,
know. I guess.
You didn't know.
You know.
Right. But that would be a big thing for your legal counsel not to tell you that. I mean, but Adam, the whole point is don't get zero CAC. You're never in the position where you're out of money. So you'd never even have to worry about a 3x. Like you control your destiny.
I absolutely love that. And then the alternative to this, which like, you know, I kind of say this all the time. It's like, look, like I have this megaphone now. Of course, it's helping me grow my business. You know, it's getting me all sorts of cool opportunities like speaking on your event. But like the thing that I want to use this megaphone for is to evangelize that if you can get to 10 million ARR bootstrapped, every reason that you started your company will have materialized. If you can bootstrap 10 million ARR in a lean way, right, with very efficient acquisition, you will be making over $1 million a year, at least, maybe even 2, right? You will be able to sell that business for like a minimum of 20 or 25 million, minimum. And that's to you, right? Like the Salesforce thing, that's not to you. and you and like, not very many businesses can pay 500 million for something. Even fewer can pay $1 billion. Hardly any can pay above $1 billion. You got an IPO, right? There are probably 5,000 shops that can pay 20 million for a business. You know, because you just literally, you take this EBITDA, and this is how private equity works a little bit. Like right now, you can go to a bank if you're a private equity shop, and they'll give you 5 times the earnings of a business in cash. And then the PE shop will be like, I'll give you, you know, you're making 2 million, I'll give you 10 million cash up front. And then the rest of it will be this equity and this combined thing that like, when we go sell this company, which we have to do in 5 years, you'll get out of the rest of it or whatever. So, you said that in this post. It's like the alternative would be somebody gets to 10 million and you're making $1 million a year. How much better does that sound? Right?
100%.
Yeah, go ahead.
No, I mean, this is, I showed you guys all those like monuments that I was building, right? To like get Latka the revenue there. Like I used all that social proof to basically go out and raise a fund where I'm now helping founders get capital without raising. And Adam, what I get so excited about is we are helping a bunch of founders exit and do secondaries now. And like, I have a list of all the buyers in these certain spaces. Yeah. And I can tell you, to your point, the less you raise, the more competition you will have for your business because there are more buyers by nature. You don't have to sell for some crazy 30x multiple.
Yeah. And I mean, so I want to go into one more story, and then I do want to just talk about Founderpath a lot right at the end, because I think it's like so interesting and something that I kind of wasn't aware of. So I wrote you this story. I'm like, will you come on the webinar? And you're like, yes. What do you want to talk about? And I'm like, man, so there's this well-known CEO who we both know very well. And she invited me into a WhatsApp chat of over 20 million ARR SaaS CEOs. And like everybody who's on this call, like you probably dream of being in this chat someday, right? Like it represents the ultimate success of a SaaS company, in my opinion. And like, it's 150 people, almost all of them are VC backed. So I was shocked to see that the person who invited me, who in my mind, like her identity is this company, right? Like she started it, like they bootstrapped the first 3 million and then whatever. She's like asking the group very like hat in hand. She's like, does anybody have a strategy for going to your board and asking for a raise? I was dumbfounded as someone, you know, as someone who's been bootstrapped for years. Like I just couldn't even believe what I was reading. And like, the piling on of like, oh my God, yeah. Who's got advice? Like, yeah, I want to know, you know, help me out or whatever. So that was one thing. And then can we share these two images? And then they start dropping in salaries of venture-backed CEOs at given revenue levels, right? So like I'm looking at this backwards now because I'm looking at a teleprompter, but
Yep.
like Nathan, I think you know a lot of bootstrap founders. I know a lot of bootstrap founders. It is not uncommon at all if you get to 10 million to be making $1 million a year, right? So all in comp is on the right side of these and cash comp is on the left, right? So these are ranges. In order to
Yep.
make $1 million as a VC-backed CEO, you need to be running a 500 million plus ARR business. That's like a $2 billion to $5 billion company, right?
Yep.
So here's my thing. I think it's so much easier to get to 10 million bootstrapped than it is to get to 500 million venture backed. Right? Like, and here's just another set of tables. This is by percentile venture backed CEO compensation, right? So the 50th percentile has a total cash comp of 230K and 14,000 of equity across the entire venture backed world, right?
Mm-hmm.
Contrast that to bootstrapping and paying yourself $1 million on a 10 million ARR company. Like, it's just like a night and day to day difference. Like the fact that this entire room of people is trying to go to their board and figure out how they're going to like pay for their private school or whatever it is, right? Put food on the table, basically. You know, living in these expensive cities, making $230,000. Like, I got kids. I don't know how that works, right?
Yep.
So the day to day of it is so much more attractive to me, in my opinion, right? And then when it comes time that you want to sell, you can find your bootstrap exit in 1 second. And then you probably end up, you know, aside from these like moonshot scenarios, which we all hear about in the press, which is part of the problem, aside from those, the probability, we've had this discussion, the probability adjusted financial outcome for bootstrapping is not only a little higher, it is way higher, right? And there's one last stat that I want to talk about, then we'll start talking about Founderpath. So like, I was
No, I
giving
think we should stay on this topic, I think,
yeah
for a couple minutes. It's a good topic.
So I was giving Sam Jacobs a hard time because he's like, growth is worth 3 times profit. It used to be worth 10 times profit, right? And I was like, Sam, and I advocate for founders. Obviously, listen to me talking, right? Like the whole thing that I'm here for is to like make sure founders are making the right decisions. So I'm like, Sam, growth is worth 3 times profit for investors. It is not worth 3 times profit for founders, because in order for founders to realize that 3x, they have to transact at a very low probability, right? Whereas the absolute certainty that you will distribute cash to yourself every month if you run a profitable business, it handicap that 3x by whatever you want on actually you receiving that. It is definitely worth less than profit at that handicap.
Mm-hmm.
It may even be worth at 10x profit. It may even be worth less, in my opinion, from the founder's perspective, right? Because a bunch of shit happens like these big unicorns where it's all, you know, whatever, 6 cents worth $5.5 billion. We're like, what happens 2 years later when they've raised venture debt and they're not growing anymore? And like, you know, it's a zombie, right? Like you just, I don't know, it leads to a bunch of bad behavior. So I really want to, I hope it doesn't sound like I'm beating a dead horse with this, but like, this is the backstory behind this belief that I think every founder should, the goal when you start should not be like, we're going to unicorn this thing. It should be, I am going to get this to 10 million ARR and then see where we're at. Right.
Mm-hmm.
Like then if you want to go raise growth equity or like, you know, try to hit a unicorn or just run a lifestyle business or whatever, you can do whatever you want or sell it or work 2 hours a week, work 100 hours a week. Anything you want is at your fingertips. 10 million ARR bootstrapped.
VC dollars are the best marketed dollars in the world, right? TechCrunch exists to make us all sort of chase this dream that effectively makes you an employee for life.
Yeah, it's incredible.
Right. I
So
mean, when one of the things we think about is if you assume that only like 10% of SaaS companies are just founders like raise VC at all, for every 1,000, right, there's 990 that never raise. And then of the ones that do raise, maybe 1%, less than 1%, actually grow into their valuation to the point where they go IPO. So to your
Bananas.
point, yes, on a risk optimization basis, never getting into that game is a much better path to growing personal wealth. And I'll back that up with this P&L, which I have permission to share. I haven't shared it a lot, so you guys are going to see it first. I want you guys just to look at this is from I'll show you the company in a second, but can you guys look at the 2019 total? This is not Adam's, but I'm sure Adam would share his if you guys ask. But look at the 2019 total, look at expenses. And I want you guys to just type in the chat. Do you see anything weird there under expenses? Come on, Richard, don't let me down. Bryce, don't let Bryce got it. Bryce got it. EJ got it. Put that in caps, guys. Put it in freaking caps.
Yeah.
Let me decode CEO payroll adjustment for you. It's called dividends, right? It's called dividends, right? So the reason I got to this, Adam, and this was, I'll give you I tried to do a show on YouTube a while back called Deal or Bust. Have you heard of this before?
Yeah. You kind of told me about it when it was going on, because I was thinking about selling get emails at the time. Yeah.
It's so difficult. Guys, what I was trying to do is get founders on live to try and sell their companies with investors like live on the fly. And so let me just show you this one. The company's P&L that you just saw is called DocHub. So if I go to Deal or Bust, here it is. Here it is. So this was live. And what you can here, I'll draw, if you guys want to watch this later, you can just bookmark it and watch it later. But what I had him do is a CEO came on, here he is, right? CEO of DocHub, Chris Dever. He's showing his product, he's showing his revenue, he's showing his traffic, his SEO traffic, he's showing his cap table that he owns the majority, right? And then he showed this P&L that I just showed you guys, right? And then all these buyers start jumping in, SaaS Group. I mean, these are real people writing real checks. So he actually gets a $20 million offer live, and you see him negotiate live. Now, what happened was a couple months after this, someone who was watching this came in and gave him a much larger offer, which he took and sold. And I can just tell you, not only did he transact and make a buttload at the exit, but he loved the grind and the process because he was paying himself, quote, a $500K CEO payroll adjustment along the way. So please, if you take one thing from this webinar, add CEO payroll adjustment to your P&L or balance sheet as you close out 2024. That's what we should be celebrating.
100,000 million %. Okay. Can we run the ARR range poll? And just, again, it's a range. We don't market off of this. We just want to know who the audience is. And we'll share it when we're done. Thank you for your participation. And let's talk about Founderpath, non-dilutive debt funding. When should you do it? When do you qualify? When are you ready? What are the use cases? What are success stories? What happens when you fail? Tell us everything, Nathan.
Well, because see, I'm biased because I'm in it every day. So it's hard for me to have empathy from folks who are just starting to think about it. So just to help me focus, let me ask you a question first. What surprised you? Because you set up an account, you have your revenue graph. I know you don't need funding, but you sort of saw the process worked. Did anything sort of surprise you about the process?
Well, I thought it was I thought it was really cool that unlike I don't know, we got 72% founders on here. I'm kind of always wondering in the back of my mind what my business is worth based upon, in anyone's opinion, right? I'll sort of take it and I'll disqualify people if I don't think they're credible, but I kind of always want to know, right? And I think, these VCs are they're prospecting you based upon that desire. It's like, what is this thing worth? What can I do with it? Whatever. I thought it was really dope that all I had to do was connect to my Stripe account. You pulled everything in. Not only did you have the sort of standard set of barometric stuff, you told me what you thought it was worth based upon other deals that are happening in the market in and around now, which was awesome. And I think you even have like you have something to do with payroll, right? Like there's much more granular financial analysis than your top level SaaS metrics that Profit Well and Bear Metrics give to you.
Yeah. Can I screen share your
Yeah,
account and your revenue graph,
absolutely.
Adam?
Absolutely.
Okay, here is Adam's.
Okay, we got
So
some pretty good participation in here. So we're going to end poll and then share results.
yeah, let's look really quick. Okay, so some pre-rev, which is great. You're learning from the right person. That is for sure. Adam is the right place to hang out. 1 to 200K. Okay, this is great. Nice range. This is good.
Yeah.
Yeah, so what you guys will see here, this is Adam's Founderpath account. I just want to go to analytics here for a second, right? So one of the things obviously that's incredible is the growth rate he's seen, right? But one of the things we always like to look at Founderpath is we like to turn off the dark green bar, right? And what I mean by that is when you turn this off, what it tells you is how much new MRR are you adding every month relative to your churn. And if you start to get this out of whack, it gets dangerous. Let me show you my account because I screwed this up royally, right? So this is the actual revenue that we made from Get Latka, right? So if I asked you guys right here, just type in the chat, good or bad. Do you think this is sort of a good or bad revenue growth graph here? Put it in the chat. There's not a right answer. I'm just curious how you guys would analyze it. Bryce, why do you say bad? I mean, this is like 0 to, it's like, what is this? I mean, this is not terrible. I mean, it's 0 to 70,000 bucks. It's sort of a one person shop in the army of contractors, right? The real reason though it's bad, right, is because watch what happens. Exactly. Yeah, exactly. So Steve, watch. When I take out start, like you said, now look, right? I'm literally starting every month in the hole, right?
Yeah.
So demotivating to wake up November 1st and go, shit, I know I'm going to have 4K of churn this month just to stay flat. I've got to go sell 4K more. And sure enough, guys, like, look at what happened. Let me turn back on start. Now, look, I also stopped focusing on Get Latka and started focusing on Founderpath, but you can see we shrunk a lot and then sort of stabilized. Now, again, there's one person running this thing right now, so it's fine. But point being is, like, Adam, one of the drivers of valuations is this quick ratio, which is new revenue divided into your churn. And what we love, like the whole reason we do Founderpath is we do it to make founders wealthy. And so one of the things we do, we haven't done this with you yet, but I got permission from Badger Maps to show this. Whenever you sell your business or you go do a secondary, you build what's called a SIM. So this is a 41-page document that basically tells you the full Badger Maps story. Now, again, I'm not going to go through every slide, okay? But we help founders with this, or we help them go do a secondary or exit. And what we do to maximize that exit price, Adam, is, like, first off, we plot the industry landscape, right? And it's not just plotting the companies. We actually go in and pull and say, this company has acquired all these other ones in your space. That's potential for industry consolidation. Here are other consolidators. We'll then go down and say, pull all obviously your metrics and your data. But then we take everyone through this 21-part SaaS valuation framework, which we automatically do after all you do is connect Stripe. And we can effectively do this and value the business. So long story short, to your point, and then you fire any question you want at me, is this is all powered by actual comps that just happened in the space. So, like, what other tools in the MarTech space just did a secondary or just did an exit? And then at the end of this 50-page deck, we we walk you through how we take founders through the sell side process to maximize your exit or your secondary, and then give you all that comp data. So this is available inside of anyone's sort of Founderpath account once they connect their Stripe. So that's what I love. And that, Founderpath, we can talk about debt, we can talk about all that, but the point of Founderpath is it's a fund that I run, 150 million bucks. The whole purpose is to help founders keep their equity so they can get really rich when they're ready to transact.
Hallelujah. Amen. I absolutely love that. Does anybody have any questions for Nathan about Founderpath?
If not, like, just explore it. Like, here's a good example, by the way, of someone that bootstrapped to 11 million, then did a massive secondary. Like Scott, if you guys go to contactmonkey.com and check him out, he's already said this publicly, so I'm comfortable sharing it. He kept all of his equity and took $1 million from us instead and grew from 1 million to 10 million of revenue, and then went and did a massive secondary for 55 million bucks with Updata. So, like, that is, I'm not going to name the CEO, Adam, that you were talking about earlier, but what I will tell you about that, and the reason I told her and him this directly, like, they did a $33 million secondary like a couple years ago. Yeah. So, like, what I tell founders is if you're going to go the VC path, please make sure you do a secondary on the first round. Like take some for yourself to start and then like go do it. But to your point, like you just take secondary or don't, like you lose control of setting your own salary.
Yeah.
Like you can close out the books in October and say, ha, bank looks
Yeah.
great. I'm gonna pay myself a dividend of 750. I'm gonna, buy a new webinar studio or whatever,
Yeah. Yeah. Okay, we have a couple questions here, Nathan. What is an ideal client for you? What do they look like? When should we start thinking about considering Founderpath?
Again, I don't want to make this a ton about me, but let me just talk about non-dilutive in general. It's really hard to use non-dilutive capital if you're anywhere under 500,000 of ARR, right? Because you haven't built like a machine that works yet. The last thing you want to do is take debt and be paying interest and not have a clear way to invest it to grow. So good things to invest in would be like new engineers, right? Or maybe you really know how your LinkedIn ads work and you know that it's a machine that works, or you know how to ramp a sales rep and have them hit 5-to-1 on target earnings to quota ratio. Those are all profitable economics, but until you have that motion, I would not recommend debt. So 500K minimum ARR is what I would say there, Adam.
Yeah. You had some, am I allowed to, the stat of your average? It was like, they've been around for X years and why. So like, I listened to Nathan present on this at his event. I was honored to be a VIP and he did this really cool presentation on like the inner workings of how a debt fund actually works. And your average client had been around for 8 years and was 4.5 million ARR, just to average, right?
Exactly.
Yeah. Okay.
Exactly.
So let's do one more. Can you talk a little about your SEO strategy around how you were inviting folks onto the pod and around how you were inviting?
This is my favorite topic that I will only share in small settings because if everybody does it, it loses its value. So I really prefer not to teach this, but I will show you. So like what Adam was talking about earlier is like he would back in the day, the way he found me is he'd search something like Notion revenue. Now, you guys search Notion revenue real quick, and then you tell me what you guys see in your like search results. Like hopefully, like you're probably gonna see us. Like how is Latka ranking above Forbes? Right? Like, how does that happen? It doesn't happen by accident, right? So like, I'll tell you how it happens. Let me first show you though, like the outcome, the result. The reason I decided that this was a board game even worth playing is because I didn't want to pay for traffic on Latka. And so if I had to pay per click, I mean, gosh, Adam, I haven't done paid ads in forever. Like,
I
what
don't
are
even
people
know.
paying
Yeah,
on
I have
average?
no,
Yeah,
I
like what
have
is
no
paid?
idea. Yeah.
Let's say $5. Let's just say $5 pay per click, right?
Yeah.
So we've gotten 1.11 million free clicks to Latka from Google organic search over the past 16 months. If I paid $5 a click, that's 5 million in savings right there because of the SEO strategy, right? So what is the SEO strategy? Well, like, let's go look. Do you guys notice any patterns here when these are all the queries people type into Google search? Do you start to see any patterns as we scroll down? Like Adam, but let's see if, yeah, exactly. EJ, Bryce, you guys are all calling it out, right? We quickly learned if we take the programmatic SEO combination of the company name plus the word revenue, we could get a lot of traffic doing that. And so what has happened is like, now if you go and look at like any of these like massive companies, like let's go look at, let's do Gong revenue, right? Big company, right? Sort of in your, kind of, it touches your space, right, Adam?
Yep, for sure.
Yeah, right. Like boom, Gong revenue, right here. Now, how did we get number one? Well, we have first party data. It's right from Amit's mouth.
Yeah.
Right. So like that's the part that it's hard to teach, right? Because that is just pure hustle. It's like go record 3,000 podcast episodes. You right? It's hard to teach that, right?
Yeah.
But the lesson there is do something you love. You can do it forever and ultimately win. And what we do is when I do these interviews, every one of the like Amit has come on every year. Why? He wants to keep his revenue accurate on Gong because potential Gong employees come to this page before they accept Gong's offer, right? Because they want to see, they use it as their research. Like VCs use it as their research before they like go do a round with them, right? So we'll email them and say, hey, your page got 300 clicks last month, but your data is from 2021. Do you want to update it? And then what happens now is people come in here and update their data without me having to do the interview. So now it scales. But the whole idea here is you need that first party data because if we didn't have that first party data, we're just another Crunchbase or just another pitch book. There's no added value.
Yep. Well, Nathan, this has been awesome. Man, you're a great guest. I
Dude,
just
thanks for having me on, man. I
Yeah,
appreciate
I
it.
just love that we think so similarly about these like things that we're sort of building our professional identities around. Where can people learn more about you? What if they want to know about Founderpath? Like, what's the deal?
I mean, look, guys, what I would tell you is the best way to learn from me is to reverse engineer my funnels. Like, just go instead of me telling you, just watch. It's better to like show, don't tell. So, like, the funnel that we're focused on right now is that one, right? So it's effectively connect, stripe, get your valuation. It's the same thing sort of Adam did. The other funnel that is working really well for us right now is this one, and the reason that here it's actually a Brunson, it's built on click funnels, and the reason that that one, Adam, is so valuable is because remember when we talked about this monument marketing right here,
Yeah,
this is getting less and less effective where my mouse is because everyone's doing it,
yeah,
right? But when you can see here that I send out 2,000 text messages, can you see this? Is it big enough, the click
yeah,
rate?
yeah. I can't actually see it, but what does it say?
It's 11% click
Yeah,
rate.
I mean, that's bananas.
That's wild. Compare that
Yeah,
to your email click rate. It's crazy.
email click rates are like 2% of the 30% open rate, right? Like
Exactly.
it's like a lie, the email click rate. It's hardly anything.
Yeah. This is 11% of total sent, not opens. It's of
Right.
total sent. So like
Yeah,
I
that's
think the
bananas.
future is text message. I have a spelling there. It's a text message list. So I want to get text messages. So why do we build a magazine funnel? I built a magazine funnel specifically so people could say, text me when my magazine ships. That's how we're building that asset. The monument is fueling the asset. What's
I
the
mean, that
other
is
asset?
bananas.
Right? The other asset here is we're getting the physical shipping address. That's the other asset we're building that's going to last forever. So like if you really want to get in my head, go sign up through those two funnels and reverse engineer everything I'm doing. That's what I would recommend.
Dope. Nathan, thank you very much. And then I'm dropping a link in here. I'm going to do my second Russell Brunson style presentation on Thursday. Please come. It's I had so much, it took forever to like sort of do this this one to many, like, you know, I'm sure Nathan could do it backwards, blindfolded, whatever, this stack and flow thing. It's such it's his nature or whatever, but I'm just starting with it. Come to that. Next week I got Dave Gerhardt on. Guess what we're going to talk about? Founder brand. And Nathan, you're the man. I'll see you around. Thank you very much.
Thanks, Bryce. Thanks, Adam. Thanks, John. See you guys.
Bye. How do I close it? I can't.
That's the fun. This
There
is
we
the
go.
fun part.
All right. Take care, dude. Thanks
See
a
you,
lot.
dude. Bye.